Hi, I'm Rick. I'm a business owner. I'm an FCA regulated financial planner, and I work predominantly with business owners and their accountants. So I get it in terms of corporation tax. Corporation tax bill is often presented to clients, and it's simply a matter of fact of paying the bill. And so with corporation tax moving from 19 to 25% on profits over £250,000, it's now more important than ever to take a more proactive approach to mitigating corporation tax wherever possible. So in the video today, I'm going to be setting out 5 key strategies to minimizing your corporation tax bill. I think on a personal level, it brings back a sense of control in that suddenly now you have the ability to make changes to your corporation tax bill. So hopefully this is going to be really useful to establish that sense of control. The other really important point is a lot of these strategies are strategies I'd be recommending regardless of their tax benefits. This is all about putting in place financial safeguards and future financial income planning. And so it's almost like the tax benefits are just a bonus on top. So let's get into it. So the first strategy is to set up specialist life insurance. So let's kind of take a step back and understand why. Often when I reflect on the directors that we work with, they have financial liabilities. So this could be on a personal level in terms of mortgages, in terms of car payments. There may be lending associated to the business. More importantly, there may be financial dependence in the mix. So this could be a partner, this could be children, and they may also have their ongoing financial liabilities, such as private school fees. So it's critical to set up specialist life insurance. What this policy will actually do is simply pay out a lump sum in the event of death. So this is very similar to a death in service payment. And essentially, it means that during a really difficult time for that director's family, there doesn't need to be a huge financial implication. So it's effectively putting a safeguard in place so that in the event of death, a lump sum can be paid out to a beneficiary or an actual trust. The second strategy is to establish something called employee significant illness cover. Now, this is a version of critical illness cover, but essentially, when it comes to life insurance, I feel most people understand it in terms of it's a pretty clear-cut policy. It pays out a lump sum in the event of death. Now, this is a pretty extreme scenario, and the probability of this is relatively low. Hence, this type of policy tends to be pretty low cost compared to something like employee significant illness. Now, as the name suggests, it's essentially a policy that works similar to life insurance, but the threshold to cover isn't that the director's passed away. It's simply that the director has been diagnosed with a serious illness that is likely to lead to immediate or anticipated retirement. So bringing this back to the real world, essentially it means in the event of diagnosis of a serious heart condition, a serious cancer, it means that it is going to pay a lump sum out. This can be used to cover things like private surgery, adaptations to the house. It could actually mean that there's a huge change in future planning, and the proceeds are then used to clear mortgages, to change the lifestyle of that individual. And they may say, do you know what, let's go on a world cruise if I've got very limited time available. This kind of policy can be really useful in this type of scenario. Now, bringing it back to how it reduces corporation tax, effectively, as long as this policy is set up correctly, it is wholly and exclusively a business expense. As a result of that, it helps to reduce the taxable profit, which in turn helps to reduce corporation tax. And so again, putting it back to why we put this into place, the tax saving is the bonus, but the financial safeguard that it provides to that individual and their family is huge in this scenario. Let's get into the third strategy. This is about establishing specialist income protection. Now, this may be the least known policy, but kind of really paradoxically, it could be the most useful. Whenever somebody were to pass away or be diagnosed with a serious illness, it's seen as a pretty major event. But something that isn't such a major event is being signed off work by an actual doctor. So this could be as a result of accident, it could be the result of short-term illness, it could be due to a mental health condition, a temporary mental health condition. And so in those scenarios, it can be a huge impact on a business to be kind of signed off from work, especially if, say, you are a tradesperson, especially if you provide the technical knowledge, especially if you are, say, the key salesperson within that business. And so there can be a huge financial impact if you are unable to work for a temporary period of time. So income protection after a waiting period works by essentially providing an averaged amount of your salary and dividends over, say, the last 3 years. And so it means after this waiting period, the business that owns this policy will then receive this income. And so as a director, it will give you the cash flow to then allow you to continue to pay yourself. It could be used to bring in temporary cover. But the really important part is the threshold for claiming is significantly lower than things like life insurance or serious illness cover. Now, in terms of how this helps to reduce corporation tax, essentially the premiums, as long as things are set up correctly, are then seen as wholly and exclusively a business expense. As a result of that, the premiums reduce the taxable profit, which in turn reduces corporation tax. But as I've mentioned with some of the previous strategies, this is a really important safeguard, a financial safety net. So even if you're not a director of a limited company, even if you're an employee, or even if you're a sole trader, this is a really important consideration. So that's specialist income protection. Let's get into the fourth strategy. And this is probably the most effective strategy. And what I really like about this is you or your family will see the financial benefit of doing this. It's going to make a material impact in the quality of your or your family's life, regardless of health outcomes. So a lot of the insurances are there as financial safety nets, which you may or may not need to claim on. And so being able to put pensions into place is something you or your family will absolutely benefit from. So let's get into it by understanding pensions. And so this is an area that is often misunderstood. Often there are negative feelings towards it. But this is such an effective strategy because at some point in your business, you will leave and look at the next chapter in your life. It may seem a world away now. It may seem very difficult to comprehend that, but at some point you will leave your business. Now, that exit could be due to you selling your business. It could be down to you kind of almost transferring the business to a family member. It could be stepping back from the business and taking on almost like a chairman type role, or it could simply be you are the business. And as a result of you stepping back and starting the next chapter in your life, the business simply ceases to exist. And so what isn't going to cease to exist is your and your family's need for income, because the state pension isn't sufficient to give you the quality of life you deserve in future. And so this is where pension planning can be a really effective approach, where you will benefit from this, but also there happens to be a tax advantage. So to bring this to life in a clear, simple way, let's look at a scenario of Peter. Let's introduce Peter. Peter is a director of a successful consultancy company. He has now reached the age of 35 years old, and his business makes around £400,000 of profit every year. This is more than the income Peter needs. And so in order to take advantage of this, he decides to contribute £3,000 a month via his limited company into a pension. So he does this for the next 20 years, which takes him to the age of 55, using a growth rate of 7%, because he's got a great financial advisor that educates him about the importance of equity-based, low-cost, evidence-based investing. What this means is when he reaches 55 years old, he's likely to have around £1.5 million in his pension. And depending on retirement ages and depending on his circumstances, this is money he can draw on to provide him with an income, or it's money that can be used to pass on to his family if he has no need for that income. So that's a really good scenario in terms of Peter's future income options. The bonus when it comes to the corporation tax saving is that every year he made a £3,000 a month contribution. The business saved about £9,000 in corporation tax. This is because the pension contribution, as it was made from the company, is wholly and exclusively a business expense, which reduces taxable profit, which then reduces corporation tax. Now, we've assumed it will be £3,000 a month, every month for the next 20 years. The reality is, as the business continues to grow, be successful, Peter will have the opportunity to increase that contribution or make a lump sum contribution at the end of his company's year end. And so this is just scratching the surface in terms of what can be created through pension planning and what can be saved in corporation tax as a result of effective pension planning. Fifth strategy, and for those who have made it to this stage in the video, this is almost a bit of a bonus, because what I wanted to introduce are the trivial gifts policies available to all directors via HMRC. And so I'll bring up the rules around trivial gifts, but essentially this will allow you to make small gifts to directors, to employees, and as long as you follow these rules, these will again be seen as wholly and exclusively a business expense. The value of these trivial gifts will come out of taxable profit, which will go on to reduce corporation tax. Now, I'm aware this is a relatively small benefit, and there are specific rules around close companies, which are the majority of companies that I tend to deal with. So it's important to say this isn't going to make a huge impact, but I just feel it's just a really nice bonus. It's something that actually lots of people may not be aware of, but it's something that actually could be a really nice way to reward staff, fellow directors, and have a corporation tax saving to boot. So overall, I hope you found these useful. This is all about starting to show you how you can take control of your corporation tax bill. And on some level, when you understand the ways of mitigating corporation tax, it helps you to come to terms with, okay, this is the figure that I'm prepared to pay. These are all the strategies I've considered to mitigating it. And so there's almost this sense of kind of acceptance of, okay, I now understand my corporation tax bill. I've looked at ways of mitigating it, and this is the amount that I'm comfortable with. So I hope you feel that. I hope that's useful, and I look forward to seeing you on the next video.